Hi, it's Eric Daly of the Molten Group, and here's what you need to know if you're a retirement plan sponsor for the week ended Friday, January the 9th of 2026. First, Happy New Year. Second, I think there was a really nice economic and market outlook published by Vanguard in late December that I think ties together a number of issues that we've been talking to clients about individually. One of which is just how strong US equity market performance has been over the course of the last couple of years and the impact that that's had on equity market valuations, specifically US equity market valuations. Related to that is the impact that AI stocks and the expectations about their growth and success have had on markets and the concentration of wealth creation among a very narrow number of stocks in the US equity market. When we look at Vanguard's stated 10-year return expectations for the market beginning now in 2026, they highlight US equities as somewhere between 4 and 5%, at ex-US, meaning international equities, at somewhere between 4.9 and 6.9%, and US bonds at between 3.8 and 4.8%. Meaning ultimately that the expected returns over the next decade for US bonds is roughly equivalent to their expectations about US equities. And I think that is probably understandably concerning to some who look at the markets and have expectations built into their own personal retirement situation of returns that are in excess of 7, 8, 9, or 10%. But it is a byproduct of the reality that, especially on the domestic growth side of the equation, valuations are very, very expensive relative to their historic norms. And as a result, much of what has been priced into those equity valuations is significant performance and success among AI stocks and technology stocks specifically. While those all may play out and perhaps may be even greater than the return assumptions or growth assumptions that are built in, the higher the expectations, the greater the opportunity or risk of disappointment is. And if there is disappointment, the likelihood is there would be an equity market contraction. It doesn't mean 2026 will be a bad year or 2027 will be a bad year. What it does mean is over the long term, the valuations at this level are likely not sustainable unless ultimately the returns or the income that's generated by those stocks grows at a much faster rate than is currently outlined in most expectations. Again, markets are a byproduct of expectations, not necessarily of fundamentals. Expectations are significant, so anything that fails to meet those expectations would drive equity market prices down. Doesn't mean that all US equities are also a low opportunity threshold. As Vanguard points out, there's certainly better valuation metrics available in the value sector components where there isn't the AI exposure or in small cap stocks in certain areas. But there is a significant change, at least as projected by Vanguard's own data, as it pertains to return expectations over the last decade. We have lived through a decade where domestic stocks have dominated international stocks from a returns perspective. It's difficult to imagine how that would play out over the next decade, given where market valuations are.